Hey everyone, welcome back to Corporate Decoder, the place where we decode the financial secrets of the corporate world. And today we are diving into Armada Hoffler Properties Incorporated's annual report, and let me tell you, they have been busy making some pretty big moves. So, what is the big story here? It looks like Armada Hoffler is going through a major transformation, shedding some parts of their business and doubling down on others, all while navigating a shifting economic landscape. It is like they're trying to reinvent themselves for a new era of real estate. Let us start by looking at their financial health. So as of the end of 2025, their total assets were about $2.6 billion. That sounds like a lot. And it is, but it is important to see where that money is tied up. A huge chunk of that, over $2 billion, is in their real estate investments. This means most of their value is in the properties they own, which makes sense for a real estate company. Now, on the flip side, their liabilities, meaning what they owe, were also substantial. At just over $1.7 billion, a big chunk of that, around $1.5 billion, is in indebtedness. That is a lot of debt, and it is something we will definitely need to keep an eye on. Looking at their income statement for 2025, they reported a net loss attributable to common stockholders of about $7.5 million. Now, that sounds bad, but it is crucial to remember this is after accounting for all sorts of adjustments, and that they took significant steps like divesting parts of their business this year. However, they did report something called Funds from Operations, or FFO, which is a key metric for REITs or real estate investment trusts. Their FFO was nearly $80 million. That shows that their core real estate operations are still generating a good amount of cash, even if the net income looks a bit rough on paper due to one-time events and accounting rules. And when we talk about their core operations, we are really looking at net operating income, or NOI. For their retail properties, NOI was about $73.8 million, while their office properties brought in close to $66.5 million. The multifamily segment, which they are planning to divest, contributed around $37.3 million. These numbers show that their real estate portfolio, before all the corporate stuff and financing costs, is generating solid revenue. Their total rental revenues across all segments for 2025 reached about $269.6 million. This is an increase from the previous year, which is a positive sign. The office segment saw a healthy jump of over 8%, which is great news given how much attention the office market has been getting lately. Multifamily also grew by more than 13%. Retail revenues, however, stayed pretty much flat, which might be a sign that market is facing some headwinds. Now, their real estate financing segment, the part they are also selling off, saw a dip in interest income down about 10% to just over $15 million. This makes sense as they are winding down this part of their business. Of course, to generate that revenue, they had expenses. Total expenses for continuing operations were just over $204 million. This includes rental expenses, property taxes, and depreciation. And then there is the big one, interest expense, which jumped significantly to over $85 million. This is directly tied to their substantial debt load. While they took steps to manage their debt by issuing new notes, the sheer amount of interest they are paying is a major financial consideration. It is important to note that they are presenting their general contracting and real estate services segment as discontinued operations. This segment brought in about $119 million in revenue in 2025, but it made a profit of only about $5 million. This move to sell it makes strategic sense to simplify their business and focus on their higher margin real estate assets. Looking at the per share numbers, they reported a net loss of about 7 cents per S-share for 2025. But again, their adjusted FFO per S-share was about 78 cents. This highlights the difference between net income under accounting rules and the cash flow generated by their actual operations. Let's scroll over to their properties. As of the end of 2025, they had a portfolio of 46 retail properties, 14 office properties, and 11 multifamily properties that they consider stabilized. That means these properties are pretty much up and running and performing well. In their retail portfolio, almost 3.8 million square feet, with occupancy at a pretty solid 94.9%. When we look at upcoming lease expirations, about 5.8% of the retail space is set to expire in 2026, and a similar amount in 2027. This is a manageable amount, and the fact that they have a good track record with renewals suggests they should be able to handle this. For their office properties totaling about 2.3 million square feet, occupancy is even higher at 96.4%. The office market has seen a lot of discussion about work from home, but Armada Hoffler seems to be doing quite well, possibly due to their focus on class of space. Lease expirations coming up are also staggered, which is good for stability. The company highlights its competitive strength here, emphasizing their high-quality, diversified portfolio, especially in the mid-Atlantic and southeastern United States. They also point to their experienced management team, whose interests are aligned with stockholders due to their significant ownership stake. This is a classic move to build investor confidence. Now, let us talk about the risks because every business has them, and Armada Hoffler lists quite a few. They are heavily exposed to economic downturns and interest rate fluctuations, which can impact their ability to service debt and make distributions. A major risk they flag is the execution of their strategic repositioning, which includes selling off parts of their business. They acknowledge that these sales might not go as planned, potentially leading to lower than expected proceeds, delays, or even losses. This is a critical point. If these strategic changes do not pan out, it could significantly hurt their financial health. Another big one is geographic concentration. A large portion of their portfolio is in Virginia, Maryland, and North Carolina. This means if those specific regions face economic trouble, it hits Armada Hoffler harder than if they were spread out nationwide. And then there is the debt. With around $1.5 billion in outstanding debt, they are clearly leveraged. This puts them at risk of default if cash flows dry up and could restrict their ability to pay dividends, which is a big deal for REIT investors. Remember, a core part of being a REIT is paying out a large portion of your income as dividends. They also mention cybersecurity risks. In today's world, any company that handles sensitive data is a target, and a breach could lead to disruptions, financial losses, and damage to their reputation. Looking at their capital structure, their series of preferred stock is subordinate to their debt. This means that in a worst case scenario, debt holders get paid back before preferred stockholders. This is standard but important to remember for anyone investing in their preferred stock. Now let's shift gears to strategies and leadership. They have a new chairman, Sean J. Tibbetts, taking over in 2026. This is part of a planned succession, which usually signals a company looking to the future. Their strategy revolves around acquiring high-quality properties, optimizing operations, managing assets efficiently, and opportunistically selling properties to redeploy capital. It is a solid, if somewhat standard, real estate strategy. But the big strategic shift is their plan to exit multifamily and focus on retail and office. That is a bold move. So, what is my take on Armada Hoffler Properties Incorporated? Well, they are clearly in a period of significant transition. The sale of their construction business and the planned divestment of their multifamily portfolio are big steps aimed at simplifying their structure and focusing on their core retail and office real estate. This focus on higher, margin-stabilized assets is a smart move, especially if they can execute it well. The major risk here is the successful execution of these divestitures and the impact of their substantial debt. While their core real estate operations seem to be performing well, generating positive FFO and NOI, high interest expenses, are a constant pressure. Their geographic concentration is another vulnerability. On the opportunity side, their strategic shift into a more focused real estate platform could lead to improved operational efficiency and potentially a stronger balance sheet if the divestitures are handled correctly. The office market, despite the work-from-home narrative, is showing resilience in their high quality portfolio, which is a promising sign. Overall, Armada Hoffler is betting on a leaner, more focused future. Investor confidence will hinge on their ability to navigate the complexities of selling off assets, manage their debt effectively, and capitalize on the strengths of their retail and office holdings. It is a company in motion, and the next couple of years will be crucial in determining whether this bold repositioning pays off. What do you think about Armada Hoffler's strategy? Share your thoughts in the comments below. If you found this breakdown helpful, give us a thumbs up and subscribe for more corporate deep dives. And hey, join our Discord community, linked in the description, to keep the financial conversation going. Thanks for watching, and we will see you in the next episode of Corporate Decoder.